Good morning, everyone. I'd like to call the meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Innu, and Dakota peoples, and in the national homeland of the Red River Métis. Drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. On the panel with me today, both joining via Zoom, are Mr. Brian Carlin and Ms. Michelle Duncan. Our assessor today is Mr. Justin Mikulek, and our administrative person is Ms. Fran Picoto. My name is Bill Moretsky. I am also joining via Zoom on the panel and will be chairing this hearing. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. Matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the Board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included in the Board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all of the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the Board will deliberate in private and make its decisions. You will receive the Board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We will be hearing items 2, 7, and 8 on the docket today. Ms. Picoto, please affirm the assessor's and the applicant's testimony.
Mr. Assessor, please state your full name.
Justin Mikulek.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you. Ms. Applicant, please state your full name.
Sarah Cates.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you.
Thank you.
Okay, our first property on the docket today is item number 2, 31 Weatherstone Place. This is an application for revision of the assessed value.
Okay.
Mr. Assessor, you may begin your presentation.
Okay. So we have file number 24-1949, roll number 0600-765-7200, 31 Weatherstone Place, roll year 2025, assessed value 10,304,000, classification 20, liability taxable. We have a commercial row house with 7 buildings that range from 2 to 3 stories. Year built 1970 to 71. We have 69 suites and 69 outdoor parking. We are located in the neighborhood of Niaqua Place, close by Southdale. So if you're just looking, these units are a parcel that are just south of Fermor. right by Niagara area, Southdale. There's the shopping mall there with the Walmart, Canadian Tire, etc. So we're in a pretty decent location in terms of ease of access to amenities, public transportation, that sort of thing. When we look at our unit mix of the income value summary, so we have 24 two-bedroom, 43 bedroom, 5 four-bedroom units with an average monthly rent of $1323.29. Putting that into the full income workup, we have gross rents at $1,095,684, less the 3.6 vacancy to get your effective gross income of $1,056,239. Expenses at 45.86% and a net operating income of $571,848, using a capitalization rate of 5.55% to get the $10,304,000 and a market value per suite coming in at just above $149,000 per unit. When you look at some rent comparables here on page 4 for the income side of things, you could see where this property here would compare to some other row houses. Now, there is the one that is also beside it. So the same company does own the one beside it. That is, it's not on the docket today, but in terms of the rents, you could see that they are in line with 39 Weatherstone. We are similar type properties again. So the rents are almost right in line. The other one does have 10 more 3-bedroom units. So the rents are slightly higher. And then you see the other 2 properties at $1355 and $1477 a unit. So really we feel we're acceptable here on the income side of things for the rents. Going to page 5, we have our capitalization rate evidence. So cap rates here on page 5, if you look at the multifamily area, which is what this would fall into. So the city of Winnipeg has a range of 4.75 to 5.45 on the 20th to 80th percentile. So that would sort of mean that if you look at, say, like a bell curve, you would see that most of the cap rates would fall between that range, and then you would still have ones that fall out on either end. But when you look at the bulk of it, they would be within that range, and then you could see how that would compare just with other broker market reports. So we aren't really that far out of line with our cap rates from that regard. Now, page 6, we've provided actual cap rate sales just to support more how the model would be applying a cap rate for assessment purposes, and then we've stabilized these sales to come up with a cap rate based on the property's reported income the year before the sale. And so you could see the ranges that we come out to. They would go from, say, 3.46 to 5.74. We have the bulk, I would say, fall in between, say, the 4.5 to 5.75 range. And then so that would just be used in this instance to just support and say, you know, if the model's projecting this type of cap rate in this instance, is it really out of line with what we've seen with market evidence? And so we feel that, again, the 5.55 cap rate that's been applied today for this property seems reasonable compared to the sales that we've come up with. Now, just going to page 8, so just providing some pictures of the property, you could see what it looks like. They are walk-up row houses. So it just says Weatherstone Place is close to major retail center with many shops, restaurant, and services. The area offers a daycare, kindergarten, grade 8 school, high school nearby, and is close to major bus routes. The features and amenities of the units would be on-site staff, washer and dryer, and suite, fridge, stove, dishwasher, pretty standard there. In-suite storage, you do get a full basement, so that's also a positive. They're really good for, say, families, because they do offer the bulk of 3-bedroom and some 4-bedroom units in this property. So from that regard, it's, I would say, really well geared towards that in a really good neighborhood. Some pictures here I've just gathered from their website, so you could see just the suites aren't obviously not super modern, but they've been maintained quite well. So you could see there's been windows done. Again, maintained well, not super high-end renovated or anything, but reasonably maintained. And just more pictures just showing the exterior. It's a pretty big area, and they do offer like a little park in there for the kids. So you do get those added benefits for tenants, especially that it's typically going to be families renting out these units. Now, if you look at the page 11 and 12 with the income statements, so for the 2022 year, they were reporting a 9% vacancy. Their expenses as well, specifically their maintenance and repair, are quite high, really coming in at well over 2,000 a unit, pretty close to 2,500 a unit, which seems quite high relative to when I look at the property itself. Now, we don't have like a full breakdown of where that repair and maintenance got distributed and how it got distributed, but it does also have really high vacancy. So, well, not really high, but higher than market for sure. Where that money's going for the repair and maintenance. And then you also look at 2021, the repair and maintenance was again close to 250,000 for 69 suites. So we're really coming in a lot on the high end. And I know the owner of this property, Ladco, they're putting in that kind of maintenance and repair to a property. I don't know if there's a sense of double counting potentially with the other property, and maybe it's just an accounting thing because they are owned by the same owner, but it does seem like pretty high repair and maintenance. And I mean, when I look at the vacancy, I did look at vacancy in 2019 and it was at 3.3%. So I think current standard, they've come to normal vacancy, but they did run a period for a few years that did have higher vacancy, and it does have really high repair and maintenance. So from that end, I'm going to defer to the model of what we're coming in at for 571,848, and the expenses being 484,391. And when I look at this property as well, from a total value perspective at 10,304,000, that comes out to about 149,000 a suite. And at that rate, you are getting 3 bedrooms in the bulk of them, and you are getting basements. So I don't feel that this property needs to be adjusted based on the parameters that bring it up to 10,304,000. And that would conclude my presentation. Thank you.
Thank you. Ms. Cates, any question on the assessor's presentation?
Yes, just a couple, thank you. So in regard to the property, it's a row house with 7 buildings. So would you agree that this style of property would typically run higher expenses than a standard apartment?
I think the expenses could be a bit higher, but that's still really, I've seen similar properties to this nature that don't run that kind of per unit maintenance and repair. Without seeing a full breakdown of how that got applied on a per unit basis, I think it would be difficult for me to use that figure.
Okay, so based on your presentation, it would be fair to say that even though you've included the property's financials, you've decided not to make any adjustments to the expenses based on viewing the actuals. Is that correct?
Yeah, that is correct. I feel that from a market standpoint, I kind of, I don't really think it would sell at 2,800 a unit R&M based on the owner of the property as well, who's running it.
Okay, that would conclude my questions for this property. I do have some rebuttal on the cap rate evidence pertaining to this file and the rest of the files. Yeah,
Did you submit that evidence or are you doing it
I
verbally?
did.
Okay.
I did submit that.
Does everybody have that?
It hasn't been distributed yet, but I will do so right away.
Okay. Okay, so noted then. You will do your presentation when it's your turn, and then we'll get to the rebuttals. Okay, Ms. Cates?
Okay,
All right. So, Mr. Carlin, any questions for the assessor?
No, I do not. Thank you.
Ms. Duncan, any questions for the assessor?
No, I do not. Thank you.
So there's 7 buildings, 69 suites. So is it evenly distributed in terms of number of suites per building?
So, like, what do you mean in that regard? I don't know the specific building, how many units are in each building.
So that are they roughly all the same size? Each building.
Yeah, like they're two there, so there's 24 2-bedroom and 43 bedroom, 5 4-bedroom units. So I would say the units, they would run pretty consistent from building to building, like in terms of size. I don't think you're gonna get a lot of variability that way.
Okay, page 6, your cap rate study. Are any of these similar type of housing, row housing that the subject property is?
No, we don't have row housing sales, and so we defer the fact that they are multifamily. And so from a cap rate perspective, we feel that they can still be shown with multifamily apartment properties.
But you would agree that they are different, a different situation in terms of managing and the spread of your units than what would, I guess, be blocks. These are apartment blocks. Would that be correct?
Yeah, they're row houses, but I still don't feel from a capitalization rate side of things, it would still fall into a group of multifamily cap rates, based on what these units offer, being that they are fairly large and they do offer a really good space for families to rent. So I think they can be reasonably put into that grouping.
Okay, I have no further questions. Ms. Cates, you can begin your main presentation, please.
okay, thank you. So if you turn to page 2 of the brief, we have a summary of some of the pertinent facts about the property, as well as our requested assessment of $8,769,000. If you turn to page 6, we have some maps. So we have an aerial map showing the parcel, as well as a Google map view showing where it's situated within the area. And then some exterior photographs on page 7 through 8. So you could see buildings are wood frame. You could see some of the exterior condition here. And you could also see the size of the site and how much there is to maintain on this site. So if you turn to page 9, we have our property description. So the subject property is on the south side of Fermor, west of its intersection with Lakewood in the Southdale area. There are 7 2-story row house buildings that were built in 1970. The property has a total of 69 units, which includes 24 2-bedrooms, 43 bedrooms, and 5 4-bedrooms. and there are 77 surface parking stalls noted. So if you turn to page 14, we have the overview of our income approach. So we are applying potential market gross rents of $1,106,436 or $13.36 per unit per month, based on the actual stabilized income reported for the property. In regard to the vacancy, typically when we're doing multifamily valuations, as long as the vacancy is stable, we would use a market vacancy rate. But when we see elevated vacancy over years at the property, then it does ask for some adjustment to the vacancy rate. And I was able to verify with the owner that the vacancy wasn't attributable to keeping units open to renovate. It was actual market vacancy, like market conditions that were causing that vacancy. So for the purpose of this analysis, I did use a higher vacancy for the property to reflect those conditions. Not using as high as the actual, but going to 7.5% to reflect that higher than market rate. And then in terms of the expenses, we're using expenses of $526,494, which is 51.1% of effective gross income. And this is based on a 3-year stabilization to the expenses, along with a 5-year stabilization to the repair and maintenance expense. If you turn to page 15, we have the overview of our cap rate for the property. So when we look at this property, our base cap rate for a property of this age, good quality, and a good location would be 5.5. It is at the older end of the range. And additionally, given the construction type, the amount of buildings on the site, the amount there is to maintain, we are doing a slight adjustment upward, still within our range prescribed, but we are applying a 5.75% cap rate to the property. So if you turn to page 17, we have our valuation breakdown for the property. So you'll see that with our income, we've also done an average to the miscellaneous income. That gives us an effective gross income of $1,030,702. So in terms of the expenses, you'll see we have 3 years of data shown here. So what we do with these is typically we would go to the most recent year of expenses, since many expenses would just increase over time, such as typically insurance, wages, property taxes, etc. But then in terms of expenses that can vary, we do take an average to account for any fluctuations in those. So that would include things like professional fees, office supplies. And then in terms of our repair and maintenance, if you could go to page 18, we have the repair and maintenance here. So it's not broken out into different categories. It's not typical for owners to supply a very detailed breakdown. But when you're looking at this, these figures are pretty consistent over time, with the exception of 2021, which I've removed from the analysis. So in terms of looking at this higher repair and maintenance, it's unlikely that there's capital included because it's stable over time. Typically, if you're going to see big capital items included, you're going to see a large jump in any given year. And what we found based on our experience reviewing these types of properties is that row house style properties do run fairly high repair and maintenance. It's not unusual to see repair and maintenance between $2,500 and $3,000 a suite for this type of property. Given the wood frame, the amount of building systems, typically these row houses have all the systems in each unit rather than just a main boiler or something like that. So that is why the repair and maintenance of these properties is going to be higher regardless of who the owner is of these properties. So in terms of our cap rate, I think this would be a good opportunity to just briefly walk through our separate document, the Altus cap rate study, just to give a bit more context for the cap rates. So if I could direct everyone to that and just let me know when I can begin.
I'm there.
Okay,
I'm there as
So-
well.
okay. So if you go to our cap rate study on page 2, we have just a bit of an overview of what makes up a cap rate. The important takeaways from this would be that the idea with a cap rate is you're converting your income and expense data into a single year projection. And that's what you use for your value indication. The cap rate is also composed of 3 major items or influenced by 3 major items. This would be perceived risk with the income, the investor expectations for appreciation, and the required returns on other investment vehicles. So if you go to page 4, we have just some further explanation from the Appraisal Institute text in terms of what we should look at in terms of coming up with a cap rate. So what we're looking at is the future income that the subject would be expected to produce. So the principle of anticipation is fundamental to this approach, and this forms a lot of how we calculate our cap rates, trying to get into the mind of the purchaser and what they would expect to achieve from the property. So if you turn to page 6, on the top of page 6, we have an overview of the city's cap rates. So from their valuation manual, while most cap rates may fall between 4.75 to 5.45, the entirety of the range would be 3.5% to 7.95%. So when we're looking at properties like this one or the ones to follow, if the risk to the income stream is higher, then it should go beyond that 80th percentile. We also have the broker reports here, so they're so just a summary of what they're saying with cap rates. They're showing minimal compression for the most part. CBRE is a bit more optimistic, but typically when we're seeing compression in the cap rates, it would be for properties that are considered the best of the best stock. Page 7, we have a bit of an overview on interest rates and borrowing costs. The main takeaway from this point is that if at the reference date, a purchaser could get a low risk government bond for 4.5% return, then we shouldn't be using those rates in terms of apartment valuation when real estate is known to be riskier, moderate to high risk investment. So the idea would be if we're doing a valuation for these apartments as of April 1, 2023, cap rates that are coming in below that rate of 5%, 4.5% should be looked at with some skepticism. On page 10, we have the factors that we might consider for adjustment. So not all factors would be applicable to all properties, but some that we're looking at today would be building type and construction in regard to row house style, as well for the properties to follow, durability and quality of income in regard to social housing. And then on page 12, we have our cap rates. So we have a range of 5.26 to 7.11%. All of our calculations are following here. So it shows exactly where we're getting our figures from and how we're calculating these cap rates. And that would kind of sum up my cap rate presentation. So I'll just go back to the main brief just to tie this up. So just back on the main brief, when we take our net operating income from the stabilized actuals of $504,209 with a 5.75% cap rate, we get an indicated value rounded of $8,769,000. I have an appendix starting on page 20 of the main brief, and I've included some marketing photos from their website, floor plan, and then just the property's financials for your review. And that would conclude my presentation on this property. Thank you.
Okay, thank you. Mr. Mikulik, do you have any questions on the applicant's presentation?
Yeah, so the repair and maintenance, you guys didn't get a full breakdown? of the repair and maintenance?
We don't have a full breakdown, no.
Okay. Are you aware of any, if these vacancy issues have since been resolved up to this point?
I didn't look past the reference point. My investigation with the owner was simply in the reference period years, what was the vacancy caused by?
Okay. And then just regarding just the repair and maintenance, like where would those like and so just to make a reasonable estimation, where would those dollars be going when you just look at a higher vacancy and they're still running the high R&M? Like would some of that be going into capital, do you think, or?
Based on my review of these figures and the consistency of them, I don't believe that items are going into capital. The distinction between capital and repair and maintenance would be that capital would be things that are thought to occur very infrequently, such as if you replace a roof, you don't have to necessarily replace it again for 20 years or so. So you'll see that for 2018, we were able to break out extraordinary repairs as well as for 2020 and 2022. But aside from that, the rest is reported as repair and maintenance. So when you're looking at where would this money go, I mean, you know, flooring, grounds, the building exterior is probably a big one. Yeah, so based on what we've seen with row housing, it's not unusual to go beyond 2,500 a suite for this particular style.
Those are all my questions regarding the property. Can I proceed to questions about the cap rate study, or would the panel like to ask questions about the property?
No, you can proceed with the cap rate study.
Okay. So just in regards here, regarding the, one second. So regarding the cap rate study over on, I just need to find the page that it was. Okay, so on page 6, there's this notion that because of the bank market and interest rates with banks that, we wouldn't really see these type of caps that were supposedly on our end applying. But when you look at the market report though, regarding all these various types of properties, the change on the right-hand side, I really don't see any besides one being a Cushman high-rise went up by 0.25%. So would you agree that maybe that correlation isn't necessarily applicable?
I'm not sure I follow the question in terms of correlation.
Yeah, so just that, well, because interest rates are increasing in the market with the banks, that all of a sudden would apply that cap rates are going up. But when you look at the chart on page 6 from the broker market reports, you can see that cap rates have been stable for the most part, if not having gone down a tick.
Okay, thanks for the clarification on that. So in terms of the interest rates, they don't necessarily move one-to-one with the cap rates, as you're suggesting. So I agree with that. The point more to the interest rate discussion is just that it poses a logical question of if we're looking at April 1, 2023 valuations for real estate, specifically apartments, real estate's known to be a moderate high risk investment, then why would an investor choose to accept a rate of return of that on that apartment when they could get a low risk government bond at the same rate? So I agree that they don't necessarily move one-to-one, but it just poses more of a logical question in terms of should we be relying on those very low end cap rates?
And then so to that end, when we talk about the April 1st, 2023 reference date, would you agree that where we are today, that was the peak of the market at that point for the interest rates?
That was the peak. No, I don't know if I agree. I think it might have gone a bit higher after.
And then regarding the comparison about a low risk government bond, would you agree that those are typically short-term investments as opposed to investing and holding real estate is really seen as more of a longer term investment?
Yes, real estate would be a longer term investment, but the purpose of our exercise today is to come up with a valuation as of that specific date.
And then these cap rates here that Altus has been presenting, is that is that what Altus would use throughout their entire department, or just is that more of just a taxation cap rate?
These are the cap rates that we've calculated from our tax department in terms of what an appraisal department or other departments would use. There might be crossover, they might have different sales that they've looked at. But these are the sales that we're putting forward based on our own calculations.
And then regarding, say, this cap rate here on 345 Talbot, did you use the income that was reported the prior year in 2020, 2021 or 2022 to get the cap rate?
What we did for the cap rate of Talbot, so if you go to page 13 of the cap rate study, what we've done, we've taken, so the property went through land titles, March 2023. So realistically, whoever was purchasing it would have been looking at it in 2022. So we've taken the expenses from the year prior of 2021. And then in terms of the income, what we did is if you look at the broker flyer that we've also provided in evidence, they state that the average rent is going to be $924 a unit. And I believe they said there was still potential even to get more based on fixing up the suites. So that's what we use. That's based on what we were saying with the principle of anticipation, that the historical income and the historical information can be a good indicator. But if you have information that they can reasonably expect to achieve a higher rent, then that should be used. So no, it's not the historical income.
Okay. But for doing an assessment, you would use their historical income, is that correct? When you're appealing subject property?
Yeah, when we're looking at the assessments, typically, yeah, we would use the most recent year leading up to the reference date, keeping in mind that most of the apartment stock in Winnipeg is under rent control. So unless you're going to be doing renovations or improvements, the rent that's obtained is the market for that property. But yeah, we will look forward. So if we know that something has been renovated and the rent is going to go up, we will consider that in our valuation. Sometimes those properties won't end up getting appealed. There's a bit of a selection bias there as well.
The property here on page 19 with 100 Maryland, did you use their actual reported information, or are these market rents that you've applied here?
So for 100 Maryland, we didn't have data for the property. It is a new apartment, so what we were able to do is apply market parameters. So when we looked at the brochure that was provided, the brochure suggested an NOI of 111,773. We didn't necessarily use that. What we did is we did a market approach to this cap rate, and this is similar to how the city would probably assess new apartments. So what we did is we looked to the CMHC rents, market vacancy, adding in some extra income for parking, as well as market expense ratio to come up with the cap rate. So it is a projection. It's not based on actuals, as we didn't have access to actuals for this property.
You know what, and I think at this point that would cover my questions for the cap rate study. Thank you.
Thank you. Ms. Duncan, any questions on the applicant's main presentation?
Just similar to the one you had for the city, Mr. Chair. For the cap rate sales, are any of those properties row housing?
No, I don't believe they are.
Okay, and then again, I'm not sure because I don't think it was in your evidence. It might have been the cities, but as far as the actuals on the I&E, I'm just curious, what would $20,000 in bad debt represent, or would you even know that? That's it's their I&E, not yours, but you know what I mean?
Yeah. So typically when we're doing our valuations, we would just kind of apply a single allowance that would encapsulate vacancy and bad debt. So typically bad debt could include things like if they're not getting their rent, they have to write something off. But you'll see in our analysis, like we have those figures included, but in our stabilization, we're not including an extra allowance for bad debt. We're just looking at it as a single allowance for vacancy and bad debt.
Okay, thank you. No further questions.
Mr. Carlin, any questions?
No questions, thank you.
And I have no questions that haven't been asked yet. So, Ms. Cates, you can begin your rebuttal. Does everybody have the rebuttal evidence? Yes, no?
Yes, thanks.
No, give me a second.
Should I begin or?
Well, I'm still waiting for Mr. Carlin. If he
Okay.
has the rebuttal.
Yeah, just give me a second. I'm just pulling it up right now. Okay, good go. Thank you.
Okay, Ms. Cates, you may begin your rebuttal.
Thank you. So if you turn to page 2, we have an overview of the cap rate sales. So they're showing a range of 3.46% to 5.74%. And again, I would suggest caution with the sales that are below 4.5%. We don't feel those are an accurate representation of what should be applied to apartment valuations as of our reference date of April 1, 2023. So if you go to page 4, in regard to city cap rate 727 Sargent and 241 Young, these are unusually low cap rates. Additionally, the city doesn't show their income approach or the supporting data. And typically when we see very low cap rates, they're pointing to the fact that the purchaser was likely purchasing a different income opportunity, not the one in place. Because it's atypical to see 3.46 and 4.21%, especially in these locations. In regard to the city cap rate 459 Sargent, the city has used the historical income in their cap rate stabilization. And based on what we're talking about with the principal of anticipation and what would the purchaser have reasonably been expecting to buy with that property, it would have been based on the rents that they were told about at the time of purchase. So when we look at the brochure, they're saying an average rent of about $740 per suite, along with $40 per stall. And when we recalculate that cap rate, we get a 5.79%. And we have the workup on page 5. as well as the MLS information with the confidential components redacted on page 6. So if you go to page 7 for city cap rate 150 Hendon, again, this cap rate is very low at 4.01%. The city doesn't show their stabilization, but presumably based on the information we had on file, they're using the historicals. Now, we had an opportunity to interview the purchaser for this property, and they were informed that when they were looking to purchase, that the vendor advised that they had received, or they had put out application for RTB increases based on some improvements to the property. So based on that, it's likely that the purchaser would have expected those RTB increased rents to come through. And what we found is, so the property sold through land titles that transferred June 2nd, 2021. The RTB orders did end up coming in. And at the end of 2021, when they submitted their income and expense information to the city, they had anticipated a gross potential rent as if it was an entire year at $712,182. And then what we see is that in 2022, once they've had a chance to operate for the full year, they were actually able to achieve something very similar, which supports the idea that they would have expected that type of rent increase. And when we recalculate that cap rate, we get a 5.42%, which is more reasonable for property of this age and type rather than a 4.01%. And I have the stabilization on page 8. And we also have the RTB orders to follow, as well as the income and expense information to support this recalculated cap rate. So if you go to page 22 for the city cap rate on 677 Maryland, there was a more recent sale. They're using the 2020 sale, but the property did transact more recently, closed through land titles March 1st, 2023, which is very close to the reference date. We have this cap rate in our study, and we have a 7.11% for the more recent sale. But we do note that even if the city NOI was used with the 2023 sale, the cap rate would be 6.2%. 2390 McPhillips, the city has this cap rate as well. It's a 2020 sale. The property was purchased with below market rents. It was bought by a REIT who would have reviewed it, would have seen that there was an opportunity here. And when we recalculate this cap rate, we do get a cap rate of over 5%. And 2390 McPhillips was a newer property at the time, being built in around 2015. And then we also have some rebuttal on some of the older cap rates from the city's evidence in 2019, but I won't go through those in detail, but just to note that 700 St. Mary's and 32 Arden were thought to be purchased with the intent to renovate. And that would conclude my rebuttal presentation. Thank you.
Mr. Mikulik, do you have any questions on the applicant's rebuttal?
Yeah, I guess my only question would be kind of pertaining to the whole methodology, in that don't you think it's only reasonable that the city calculates their cap rates based on the same way that we review our assessments? And that being that we take the most recent historical reported income?
Well, the city doesn't publish how they calculate their cap rates, so there are some questions around that. You just submit the final sales, whereas we submit everything.
So I guess my question would be, we did provide sales evidence and we came to those numbers based on stabilizing historically, which is how, when we look at assessments, as we just did on the prior property, we've looked at all the historical reported information. And so don't you think it's only fair appraisal methodology that we approach the cap sales the same way?
Well, I don't believe that we're being inconsistent with our cap sales. When we're looking at assessment and valuation for assessment, there's artificial conditions in place of a reference date and year of physical condition. When we're looking at coming up with a cap rate, we have to do analysis. It's not just a simple data entry. We have to do analysis. What would they actually expect to get? What income stream are they actually purchasing? So I don't necessarily believe, as I think might be implied, that we're being inconsistent.
Those are all my questions. Thank you.
Mr. Carlin, any questions on the applicant's rebuttal evidence?
No, thank you.
Ms. Duncan, any questions?
No questions, thank
And I have no questions. Mr. Mikulik, any summation on your evidence today on this property?
I would just say for summation, just to, again, our application of the cap rate, I think is perfectly reasonable given the way we've stabilized our cap rates here. And so I would ask that the board consider that our cap rate is acceptable. Thank you very much.
Ms. Cates, anything in summation?
No, thank you.
Okay, then we'll conclude this item 231 Weatherstone Place. We will now proceed to item number 7, 1377 Winnipeg. This is an application for revision of assessed value. Mr. Mikulik, you may begin your presentation on this property, and I believe this is a cap rate issue.
Yes, this would be mainly just resorted to cap rate.
Okay, you may proceed.
Okay. So we have file number 24-3029, roll number 130-625-20000, address 1377 Winnipeg Avenue West, roll year 2025, assessed value 1,813,000, classification 20, liability G, as it is a grantable property because it is owned by Manitoba Housing. It is a row house with, there are 2-story row houses, 22 buildings, 1984 build, number of suites 21. And we can see here where it's located here on Winnipeg Avenue. So it's just north of Notre Dame in the Pacific Industrial Weston area. Again, areas probably it's not as good of a location in terms of, I guess you could say socioeconomically than the prior one we spoke about, but it's still close to amenities. And so from that regard, there's still people that rent these properties. There's still demand in these areas as well. Now, when we look at the income value summary, we see that there's 14 2-bedroom and 7 3-bedroom units on this. We have an average monthly rent of $900. Now, when you just look at the full breakdown, that gets you to 1,813,000. You could see what our NOI is. We are using a 4.9% cap rate here, and a market value per suite of 86,000 per unit. So, again, like this prior property, we were at 143,000 for a standard market apartment per unit. We're here at 86,000 a unit because I know it gets pointed out too that the cap rate is low, but when you look at it from a total value perspective, because the income we have on this property is significantly lower than market, I don't feel that 86,000 per unit is really out of line. In fact, it's really on the low end of price per unit basis. So when I look at it from a total value standpoint, again, 1.813 million seems reasonable with these parameters. Now, when you just look at the rent analysis here, so for these type of properties, we do just go to market because we can't use the reported income and expenses because it is Manitoba Housing, it's all subsidized through them. So when we look at it here, this property, using zone 2 rents, like if you were to look at in this exact market region, these rents come in at 80% of what market rents would be in this location. So again, even these areas with a lower socioeconomically, we're still coming in, like average market rents are $11.29 per unit, really, when you factor in these tables. So we've recognized here that this is a Manitoba Housing property. We have given well below market rent application here. We've also gone with really high expense ratio. So we think we've reflected the overall condition of this property appropriately. And then when you look at the cap rates again, so page 6, based on our cap rate evidence, so 4.9% would still fall in line with where we believe we've properly stabilized our cap rate properties. When you look at, say, the range like 727 Sargent, 459 Sargent, 241 Young, 473 Burroughs, 677 Maryland. So when you look at those ranges of value, we're at a 4.9. I would say that the model would still support this application based on the type of properties that have sold and that we've gone well below income than market on a property such as this. Now, when you look at page 8, I've just provided just some exterior pictures I was able to gather. So off of Google, you could see that the property, it's reasonably maintained for the most part by Manitoba Housing. And they got a little park there on page 9. So you could see that you know, it's the location gets disputed, but it's still well maintained. It's still got a okay amount of amenity here for the kids, and the cap really still falls in line with other market caps as well. So really, if you were to look at a Manitoba Housing property, you could make a case as I guess they talk about that there's a lot of income potential really if it were to sell. Now, I'm not saying we assess it on that, but these properties, because of the clientele they have, they would have, say, maybe some more income potential than some of the other ones, but we don't really go into realizing that in our valuation, but just throwing it out there. Other than that, that would conclude my presentation, and I welcome any questions. Thank you.
Well, thank you. Ms. Cates, any questions for the assessor?
Yes, thank you. So if we go to your income value summary on page 3, is the model treating this like social housing, or is it treating it like a low-end market apartment?
I would say it's we recognize that it's Manitoba Housing, so I would say it's treating it as such.
You recognize it's Manitoba Housing in the income,
That's correct.
but your other parameters would be considered market, would they not?
The expenses would be considered also Manitoba Housing. And cap rate, just so, because I know that that's where kind of the question probably was leading, was we use a market cap rate in that application.
Okay. So in terms of your cap rate, on page 5, in terms of the ranges that are provided, 4.75 to 5.45, do you have any information on the sales that are being used to achieve those ranges, such as how many sales or the location of the properties, etc.?
I don't know the exact number of sales, but our department does look at all the sales that come through that are registered through land titles, and then in that application, that is how we come up with our cap rates. Now, again, because everything we do here is based on historically reported income, when we get those sales and we look at historical reported income, as was seen in the cap rate evidence, you will naturally tend to get lower cap rates because you're using historical reported income. So in theory, when you see this principle of anticipation where you get putting a higher income on the sale, which will just drive a higher cap rate naturally, but we are using data that's in arrears. So to come up with those cap rates itself, like you had spoke of with the sales, I don't have the number, but I know we use the parameters on the income that gets reported to the city along with the sales that come through our department to drive these numbers and get this range that we come up with.
Okay. And then in looking at this same table, the broker cap rates are stated to further support the assessment department cap rates. Is that correct?
That's correct.
And so for a low rise B, they would suggest nothing lower than 5%, whereas the cap rate for the subject is at 4.9%. Is that correct?
Yep, that's correct.
So is it the city's view that this social housing property is then one of the best investments in the city?
It's the city's view that the market cap rates that we apply to social housing properties fits within the range of the 20th to 80th percentile of our cap rate distribution. And those market evidence that we have are still supported by us on the sales that we've provided on page 6 in areas that you could deem that are poor location.
And then you're talking about cost per unit in your presentation, but 727 Sargent is at 72,000 a unit, and Young is at 57,000 a unit roughly. Is that correct?
That is correct.
Okay, thank you. That would conclude my questions on this property.
Ms. Duncan, any questions for the
Just,
assessor?
is any of the sales comparisons, are any of them Manitoba Housing?
They are not.
Thank you. No other questions.
Mr. Carlin, any questions?
No questions, thank you.
Okay. So you're saying that this is a low income? Net
That's-
operating income, 88,845 is low. Is that what you said?
The net operating income at 88,845, yes, based on the income parameters that we've applied to the property. When you look at our CMHC rent analysis, the market rents are coming in 20%, like our model rents are coming in at 79.68% over on page 4, and then what we have an expense ratio that's 58.64%. So yes, that net operating income would be quite low.
So if the net operating income is low, then wouldn't a buyer feel that this is a higher risk? He's getting a low income.
Well, like I said, you could make a case, they could look at it and there's a lot of income potential for a property such as this, right? So I think we defer to market caps because we've seen Manitoba Housing appraisals that have been done on their behalf that have used market caps that are well below 5%. Unfortunately, I can't provide those because there's too many privacy restrictions around them, but being under oath today, I can definitely speak to that, where this application of cap rate for us isn't unacceptable.
Okay, no further questions. Ms. Cates, you may begin your presentation.
Thank you. So if you turn to page 2 of our brief, we have our requested assessment of $1,422,000. Page 4 for the scope of work, we did have a site visit to this property by a member of our office in May of 2023 that included an interior and exterior inspection, and I've provided those photos in my appendix. If you go to page 6, we have our site maps, so the aerial map view as well as the Google map view, and then some exterior photographs of all of the buildings or a depiction of the different buildings on the site. We have our property description on page 9. So the subject property is on Winnipeg Avenue West at its intersection with McDermott Avenue West in the Weston area. There are 10 two-story row house buildings built in 1984. There are 21 units, which include 14 2-bedrooms and 7 3-bedrooms. And there is surface parking located at the site, and the property is also adjacent to a rail line. I would suggest locationally, this is in a more challenging location in the city. If you go to page 14, we have the overview of our income approach. So the subject property is social housing. It operates on a rent geared to income basis, which means that the income produced by the property is not at market. So in rent geared to income, tenants would be charged a rent based on a defined percentage of their income. So for example, rents of $300 a unit might be actually achieved by the property. So what we do is we look to the market to have a market rent in place. So when we look at the rents that are assessed at $226,830 or $900 a unit, this is in line with the CMHC rents, and we use it in our analysis. So as further background, when we're looking at CMHC, and the assessor mentioned in his presentation that it's at 80% of CMHC, that's within the range that we would expect for social housing, potentially even on the high end. Because when you're looking at CMHC rents, it's just averages. You don't have the entirety of the range. So there's going to be renovated properties or newer developments that are going to bring up those averages. So when we're looking at social housing units, which are typically smaller than market of the same bedroom count, as well, they have more basic or utility grade finishes, we should be at that lower end in the range, somewhere at 70 or 75 to 80%, somewhere in that range. So when the assessor mentions in his presentation about income potential, we are capturing that in the analysis. We're not using the actual rents of, $300 a unit. We're using a higher market rent, but accounting for the lower end finishes, the smaller size typically of these units. In terms of the vacancy, these properties may not experience market vacancy rates. So for the purpose of the analysis, we apply market vacancy rate of 5.3%. And in the expenses, we're applying $125,963 or 58.6% of effective gross income. Like we mentioned in the first property, these type of row house properties tend to run higher expenses. Seeing something in the range for market stuff, mid 50s to low 60s is not unusual. So I would suggest that all of these parameters that we're using in the NOI are market parameters. These aren't specific to social housing, as the assessor implied in his presentation. So on page 15, we have the overview of our cap rate for social housing. So when we're looking at these type of properties, informed by Richard Poulton, who wrote valuations and market studies for affordable housing, the idea is that we should start at a market-based cap rate because these properties don't transact in the market, and then adjust upwards for risk factors that might be present at the properties. So he breaks these risk factors down into a variety of different factors, but they could really be summed up into 4 broad features. These would be low cost or low quality construction, advanced age, declining neighborhood, and low income tenancy. So when we're looking at the features, not all are present at all properties, but all of the social housing properties do have low income tenancy. So if you turn to page 17, we have a summary of low income tenancy and its relationship with deferred maintenance. So what happens is these properties don't earn enough income to cover their expenses. They receive funding so that they can operate and continue to operate, but it is not enough funding to then cover those more preventative or maintenance items that market apartments would be able to do. So what tends to happen in these properties is that issues will build up over time. Issues will build up in severity. So a specific case study that highlights this is 185 Smith, where issues were continuing over time. What ended up happening, it was a building from the 70s, and the building flooded due to issue with the water pipe. Even after putting $3 million into the property, it still wasn't enough to be able to move tenants safely back in. So this just speaks to the underfunding of these properties and the issue of deferred maintenance that accumulates over time. So when we're looking at a property like the subject from the 80s, it's going to have deferred maintenance in it. And we can see how these issues happen when we look at 2017, there was estimated there was about $500 million of deferred maintenance over the portfolio. And when we jump forward to 2020, in terms of what they're actually able to put toward these properties, they're only getting about 30 million per year. So it shows how these issues escalate over time. The other thing I'd like to point out with the cap rates for social housing is that prior board orders do suggest that even with a lower end income, potentially even higher vacancy, higher expenses, a cap rate premium is still reasonable. So if you turn to page 19, we have the overview of the cap rate for this subject property. So our cap rate study that I've previously presented informs on how we get to our base cap rates. And then in terms of this property specifically, we make adjustments considering the building type and construction, the low income tenancy, no amenities at the property, condition somewhere in the range of below average to inferior, and as well locational. And so we get to a cap rate of 6.25%. On our valuation summary on page 21, we show that with the net operating income of $88,845, along with a cap rate of 6.25%, we get a rounded value of $1,422,000. And then we've included some photographs in the appendix. So you can see the units, pretty basic in nature, as well just some further information regarding our cap rate adjustments. And that would conclude my presentation on this property. Thank you.
Thank you. Mr. Mikulik, any questions on the applicant's presentation?
I have no questions. Thank you.
Mr. Garland, any questions?
No questions. Thank you.
Ms. Duncan, any questions?
Just one sec. No questions. Thank you.
Yeah, I have no questions. Anything in summation, Mr. Mikulik?
Yeah, just I wanted to clarify so first summation, I had gotten asked about the price per unit. Now I would say that the price per unit we've applied here at 86,000, these are larger units that are 2 and 3 bedroom and do have basements. Whereas the price per unit in our sales were from apartments that were they were a lot smaller than the units we are speaking of here. So again, I just wanted to stand that we are at 86,000 and that is really reasonable. So that's all I have for summation.
Ms. Cates, anything in summation?
No, thank you. I might just do a summation at the last property. Thank you.
Okay. So given that there's one property left for the assessor and the applicant to present, I will leave it up to them whether they want to have a break now or continue.
I mean, I'm okay to continue if everyone else is.
Ms. Cates, you okay to
Yeah, that
continue?
sounds good. That sounds good.
You'd rather continue? Okay. We will continue then. On to the next. Item number 8, 250 Evanson. This is an application for revision of assessed value. And I believe this is a cap rate issue only as well.
Yes.
Mr. Mikulik, you may begin your presentation.
Okay, so we have file number 24-3273, roll number 120-823-30000, address 250 Evanson. So classification, roll year 2025, assessed value 602,000, classification 80T. As this is it's a 4-unit building that was built in 2018, assessed value 602,000. So it is like a residential house that we are assessing as an apartment. Now you could see there was a sale March 31st, 2016, 570,000. There was an older property that was knocked down and a new one was built. So we do have 4 units located in Wolseley. So a good look over there on page 2, a location that is just south of Portage Avenue in the Wolseley neighborhood. So a decent area in terms of rental availability and close to amenities and public transportation. Now, there is 4 3-bedroom units here. We have gross rents of 54,529 and expenses 47.3% to get a net operating income of 27,702, a cap rate of 4.6%, price per unit of 150,000 per unit to get our 602,000. Now, when we look at the CMHC rent analysis again for the area that this is located, so zone 3 rents, we just look at, again, we're looking at the CMHC townhouse rents for zone 3 Midland, so it would be encompassing of this market region. And you could see for 4-bedroom would average out to 1363 per unit in this market region. Now we have a modeled rent of 54,529 and 83.35% of market rents. Now this is also a new build. So we are coming in a little bit higher than the prior one, but again, we're still well below CMHC market rents, which for a new build, you could see where they would be at 1363 for this market region. And also giving that they are 3-bedroom units as well. So when we look at, say, our cap rate discussion again, we're at 4.6. We still feel that 4.6 is okay given the specific nature too of this property. It is a 4-bedroom it is a 4-bedroom dwelling. It doesn't have a significant unit count. It can get a lot of buyers to the table for a property such as this. So from a market cap perspective, which is how we look at these properties, we don't see how 4.6, it is on the lower end from what we discussed, but again, you get more buyers at play for properties like this in the market. So we don't feel that we're out of line there in that application. Now, I was only able to get page 8. This is an exterior picture from 2018 or 2019 when it was being built or close to being finished. So you could see just what the general look of the property is. And it's obviously a newer build. I don't have interior pictures of it. So I would imagine they're not going to build anything high end. We understand that. Our rents are coming in below market for new property, where we have a region, Zone 3 Midland, where these properties would be taking in all different kinds of builds. So the fact that we are a new build on the lower end, I don't think is unreasonable in that application. So other than that, that would conclude my presentation. Thank you.
Ms. Cates, any questions for the assessor?
Yes, thank you. So in regard to the sale on page 2, that was a multi-role sale including another property, is that correct?
I honestly, I don't really, is it? I didn't notice that.
Okay. And then page 3, your income value summary, the cap rate at 4.6 would be below the city's 20th percentile, is that correct?
That is correct.
That would conclude my questions. Thank you.
Mr. Carlin, any questions?
No, not for me. Thank you.
Ms. Duncan, any questions?
No questions, thank you.
And I have no questions. Ms. Cates, you may begin your presentation.
Thank you. So if you turn to page 2, we have our requested assessment of $528,000. On page 6, we have our property maps and exterior photo on page 7. Page 8, we have our property description. So the subject property is located at the intersection of Evanston Street and Preston Avenue, west of Arlington in Wolseley. The property is a 2-story row house built in 2018. There are 4 3-bedroom units, and there's surface parking somewhere between 12 to 14 and 15 stalls, just based on my own counting. If you go to page 13, we have our income approach. So similar to the last property, these properties should have lower end market rents. We use a market vacancy and market expenses. Cap rates for social housing starts on page 14. So the same comments would apply as from the previous property. Granted, this property is newer, so it wouldn't have the deferred maintenance yet. But that would be the trajectory of the property going forward. So if you go to page 18, we have our cap rate for the subject. So we're disputing the cap rate of 4.6%. We're applying a cap rate of 5.25%. When we look at the age of this property, we would start at a base cap rate of 5%, but this is social housing. There's not going to be any amenities. It's going to be lower end, lower quality than newer market apartments. So we're doing a slight uptick in the cap rate to 5.25%. It's still within the range of what we prescribe for new properties. And we don't subscribe to the same idea of the city that smaller complexes should have these very low end cap rates due to competition. It's not necessarily like a founded idea. If you go to page 20, we have our valuation workup. So we have a net operating income of $27,702 with a 5.25% cap rate, gives a indicated value of $528,000 rounded. And then in the appendix, I just put a bit of a news clipping around this development, this property, and then just the same information with the social housing. And that would conclude my presentation on this property. Thank you.
Thank you. Mr. Mikulik, any questions for the applicant?
I have no questions. Thank you.
Ms. Duncan, any questions?
No questions, thank you.
Mr. Carlin, any questions?
Nope, no questions. Thank you.
And I have no questions. Anything in summation, Mr. Mikulik?
Nope, I'm okay. Thank you.
Anything in summation, Ms. Cates?
Just briefly, so when we're looking at these social housing properties, we provide a lot of background in terms of how we're arriving at our conclusions. cap rate study that's applied to all the properties today. We're very transparent in terms of our figures and the backup data that we use. So I would just ask the board to consider that more transparent, fulsome approach in evaluating these properties today. Thank you.
Okay. That then will conclude item 8, 250 Evanson. And we have heard all the items scheduled this morning, and this hearing is now adjourned. Thank you very much for your presentations, Ms. Cates, Mr. Mikulik.
All right, thank you. Have a good day.
Have a great day. Yeah.
Thank you.